30 minutes. On the agenda today, Girish Pai, Head of Institutional Equities Research at Nirmal, joins us to discuss market valuations and whether or not it is the correct time to invest in the markets right now. And PV Ramesh, Chairman and Managing Director at REC, joins us to give his outlook for the business going ahead. And we discuss Centrum Broking's report on high dividend yield stock picks with Jagannathan Thunugunthal, Head of Equities Research at Centrum Broking. But before we go across to all our guests, let's quickly take a look at how the market is trading at this point. And it is flat with a negative bias as far as the Nifty goes. I remember we saw that gap down opening and we're really holding at that level that we opened at. We've recovered from breaching 10,200. So we're trading above the 10,200 mark right now. But we did breach that mark just a short while ago. 10,230 is where the Nifty is trading at this point. Advanced decline is at about parity. And if you look at it sectorally as well, we're seeing metals, pharma, PSU banks, private banks, realty, that's where we're seeing the most amount of pressure. Bank Nifty down about 0.4%, and gains coming in for the FMCG pack as well as the IT pack. Both these sectors up about 0.7%. But overall, as far as the market goes, it is under pressure, continuing to see that sort of pressure that we've been seeing since trade yesterday. We'll keep our eye on that as we, of course, go ahead. Keeping the focus on the market as a whole, are valuations finally attractive enough to warrant investment in the market after the kind of corrections that we've seen recently? To really understand this and get some top stock picks in a volatile market like this, we're now joined by Girish Pai, Head of Institutional Equities Research at Nirmal. Girish, thanks very much for joining in. Good to have you on the show. First off, I just want to get your reading of the market at a time like this. We'll go into sectors and all of that. But first off, there was an expectation that we would see a recovery much before this. Where do you really come in on this? Do you think that we're looking at a prolonged period of pressure, at least as we go into, the end of the fiscal, the rest of this month?
Yes, so I think over the next 2 to 3 months, I think that market should be under pressure because I think we have a confluence of both global and domestic factors which could pressure the market. So over the last 2-3 months, global pressures have come through because of issues connected with, issues connected with tightening on the monetary policy side in the US, and the issues connected with potential 3 to 4 rate hikes happening there. Subsequently, we've had in recent times an issue regarding whether there could be trade wars between the US and some of the other large developed markets happening because of what action President Trump has taken on tariffs on steel and aluminium. On the domestic front, macros have been worsening over the last many months now, while growth is kind of picking up. If you look at the fiscal deficit, if you look at the current account deficit, if you look at where inflation and interest rates are kind of heading, I think macros have been kind of worsening. The only kind of bright spot has been the earnings picture, which is kind of diverged from the macro picture, and the third quarter earnings numbers, if you take out SBI and certain oil PSUs, I think the numbers have been fairly decent. And I think that kind of trend will continue into FY19. But the only thing here is that what a new development that's kind of coming in over the last maybe few weeks is the situation that's developed because of certain regulations that have been put in by the RBI, new regulations that have been put in by the RBI with regard to NPA recognition, which in our view could lead to earnings being downgraded a tad in FY19. So if you look at consensus earnings expectation on growth for Sensex and Nifty, that's somewhere in the region of 20 to 25% growth for next year, and a lot of the delta is coming from corporate banks. And I think that might have to be paid under the circumstances of having to recognize a greater deal, the non-performing assets. So I think this is the kind of, how the variables are kind of stacked up vis-a-vis the markets. And therefore, I think the 4Q earnings picture is looking a little muddied, especially on the corporate bank side. That is kind of pressuring the market, and that will probably continue even into the June quarter. So I would think a 3 to 4 month kind of time frame, we will probably see the markets coming in under a little bit of pressure. That's on the domestic front. Globally, obviously, there are issues with trade wars and tightening that will continue to be an issue.
Absolutely. Girish, very fair point you're making there. Earnings seem to be the only respite from the sort of cues that we were getting, the triggers for the market. And now with those new RBI norms, there is this, fear at least, not just from the bank side of things, but a number of companies that were otherwise, undergoing SDR, CDR, S4A, any of these restructuring tools. Now they are on this fast track, really. There are these strict timelines to push them through to the IBC. So let's talk about the financials first, because, in terms of the performance, if you look at it, the bank Nifty has lost about 5% since the beginning of this year. And of that, the PSU banks really the biggest loser. And it's not surprising, down about 22% nearly YTD. PSU banks as a proportion of the Nifty, of course, there's only the State Bank of India there. But sentimentally, there's quite a bit of impact. And we've been seeing that play out over the last few days. What is really the sense that you're getting in terms of PSU banks at this point? Do you think we've reached a bottom here? And on the other side of things, in terms of the PNB fraud case, at least, we're seeing the impact spread to private players as well. And we're seeing a bit of a correction come in for big private banks, ICICI Bank, for an example. Where do you see the bottom for private banks?
So I think we will have to watch out for earnings in the fourth quarter. I think already SBI has come out and said that there could be fairly large provisioning done in the fourth quarter, but one really needs to see whether it's going to be as large as the kind of provisioning it did in 3Q, which led to a loss in that particular quarter. So we could probably see a lot of kitchen sinking kind of situation developing in the PSU bank space, considering the kind of action that has been taken by RBI. And also my sense is that some of the skeletons that are probably hidden in the cupboards of the both public sector banks as well as probably private sector banks are probably revealed out. I think one of the issues that the government is facing is that come 2019, it doesn't want to see any skeletons pop up to subject it to pressure when an election is coming up. So my sense is that the government wants a cleanup act done by the banking system, be it the PSB side or the private side, especially on the corporate loans that have been given out. So I think it would want to do the cleanup by the end of the June quarter at the latest. So my sense is there's going to be a lot of provisioning that's going to be front loaded. It might happen in the March and the June quarter. So profit picture for PSBs are going to look fairly bad for March and June. But having said that, if you take a slightly longer term view of the sector, I think that cleanup act was required. A lot of these NPAs have been pending for a very long period of time, and somebody had to take that call to do the cleanup. I think RBI and the government is forcing the hand of the banks to actually do that. So from a longer term perspective, I think it's good, but from the very short term, I think it's going to lead to some issues connected with profits and book value. There could be a situation where the government will probably have to pump in a lot more capital than it had initially thought of. So those are things that are in the immediate term, but if you take a slightly longer term view, I would be more positive on private corporate banks. I think probably they are better managed, and I would say the loan origination capability is probably a little better out there compared to the PSB set. So within the PSB set, I would, if I take a 3-year view, I would take a bet on SBI and maybe a BOB. I would avoid the other PSU banks. So if you take a 3-year view, I would take a bet on the corporate banks, be they the public sector side or the private bank side.
All right, so corporate banks really is where the focus should remain as we go ahead. Girish, then let's talk about, from the banking space, which really has been under the most pressure, the IT pack, because it's the only spot of green. If we look at it sectorally on a YTD basis, the IT pack has moved up 10% since the beginning of the year. And fundamentally, there still is quite a bit of concern that remains for these IT companies. A lot of the fundamental triggers, the kind of slowdown that we've seen, none of that has really returned. NASSCOM has revised their guidance downwards once again for this year as well. Fundamentally, what's your take on the IT picture right now? And do you like any of these stocks at these levels? Because they have run up a bit, but they have been under pressure as well for some time.
Yeah, so we've been negative on the IT services sector for about 3 years, since April of 2015, and the IT index, since we initiated coverage on the sector in April of 2015, had underperformed the Nifty by almost 26 percentage points. So this is till December of 2017. Since then, we've kind of put the sector under review. The sector has actually outperformed the Nifty in the last 3 to 4 months significantly. I think that's largely technical in nature. I think the fundamental reasons for outperformance are still not there. Technical because I think the whole institutional investor base was under invested in the sector. It was a huge underweight, be it the DIIs or the FIIs. The sector was a huge underweight. So relatively from a fundamental standpoint, the huge overweight sector, which is the financial sector, was facing pressure because of rising interest rates, rising inflation, stressed assets numbers looking up. On the one hand, the overweight sector was facing pressure on the fundamental side, whereas the underweight sector like IT was seeing a little bit of an uptick in growth, which is what I think will probably happen in FY19. While I do not agree with a large part of my competitor set, which believes that growth is going to pick up very robustly and be sustained going into FY19 and 20, I think there is going to be a slight uptick in FY19. Having said that, I do not think that's going to sustain going beyond that. So therefore, I think from a relative standpoint, yes, it's a relative bet as of this point in time. The financials, the big, large overweight sector financials is not doing well. So as monies continue to flow in, while the inflows may be a little slower than what they were in, say, December and Jan, I would still think that money has to go somewhere, and that somewhere could potentially be IT. So IT could still be outperforming the Nifty for some more period of time until a situation arises when money can flow back into financials. And I see that happening maybe in the next 4 to 6 months once this whole NPA mess kind of clears up. Once I think the June quarter results are through and a lot of the provisioning is out of the way, I would probably think that the market would probably start betting on the financials again, and probably there will be far greater clarity on how the inflation picture is going to look going into FY19. So IT, I would think it's a very short-term bet to take if you want to outperform the Nifty. But if you take a structural view on the sector, I don't think it's out of the woods as yet. I think earnings growth is going to be still very meager. I think it's going to be at best high single-digit variety. Whereas I would think an investable sector should be giving you something like mid-teens kind of growth over the longer term, which I think the sector can potentially not provide, at least in the tier 1 set. So from a structural standpoint, I would still be cautious on the sector, but in a very near term, it can potentially outperform.
Right. So no big magical turnaround, that some people have been waiting for in the IT space. All right, Girish, then very quickly, we're running out of time here. Just want to get a sense from you, barring financials, IT, you're saying, is not as optimistic as perhaps other people are on this space. What are you liking in a market like this, where we're reaching, we've come off quite significantly from the highs that we were at. If you're looking to enter into any sector, into any stocks at this point, what is your conviction call?
Yeah, so we have to go stock by stock and micro segment by segment of the market. I mean, it's going to be very difficult to take a sectoral call and say, okay, this is a sector to back at this point in time. But if you take a 3 to 5 year view, I would think there are stocks and subsectors within larger segments of the market which look attractive. These are largely unrelated or unconnected with what's happening globally and even in the Indian macro situation. So one of the areas that we like are select auto stocks. So we like the two-wheeler set or even auto ancillaries supporting the two-wheeler set. So we like Hero MotoCorp quite a bit right now. So the stock has corrected from its highs. And we think that it is going to be a beneficiary of one rural uptick with higher MSPs coming through, with greater level of premiumization, with greater level of scooterization. There could also be a situation of replacement demand coming through. So Hero Honda to us looks a good bet to take. There's another company in the auto ancillary space called Gabriel India, which is into ride control products, the shock absorbers and stuff like that, which largely caters to two-wheeler OEMs like TVS Motors and HMSI, which are one of the other bets that we have in the auto space. Other than that, we like players in the consumer appliance side, Whirlpool India, IFB Industries. These are two stocks which we like, are a play on urban, the urbanization. I would say low penetration of consumer durables of the kind of washing
Right.
machines and refrigerators and stuff like that. So these are some of the stocks that we like with
All
a
right.
3 to 5 year view.
All right. So with a 3 to 5 year view, auto ancillaries, number of sectors there, and of course, earlier on you mentioned SBI, BOB. If you have to choose from the PSU banking pack, set to really be the ones to see good growth once we can put this sort of trouble behind us. Thanks so much, Girish. Always appreciate having you on. That's Girish Pai of Nirmal Bang, really giving us a sense of where markets are headed from here. But let's put the focus now on the Rural Electrification Corporation of India. They've approved the sale